What's really good? What's really good? Back at it again. If you're in the Instagram or the Discord, well, if not, then you wouldn't know. Just finished the week with a 100% win rate, though. So go tap into the Discord. It's free. Signals are free as well. Therefore, you can make money with with no risk. Only risk is what you add. You feel what I'm saying? So, yeah. So you can go tap into that. Discord's free. First two mentorship sessions are free. You got two of those for an hour and a half if you haven't used them yet. All that's going to be in my link tree in the bio, including the gram. And yeah, but today's video, I'm going to be teaching y'all how to properly chart up. Obviously, trade stocks, trade options. So there are going to be things in here that aren't going to be utilized for certain markets, whether that's crypto, Forex, whatever. But as long as you're within the stock market, so you got, market closed and market open, some of the POI zones you will actually use. If not, then everything else but one of the three POI zones will go over is actually going to be used. All right. But yeah, I'm going to be teaching you how to properly chart up the night before or the day of, so then you can have the absolute best, perfect, prominent chart set up. Therefore, you can take beautiful, valiant trades without any issues, without any worry, without any doubt. And yeah, just finish a day with a beautiful day and finish a week with a beautiful week. You feel what I'm saying? So let's get straight into it. Obviously, if you're in the stock market, market closes at whatever time that closes for you, depending on your time zone. For me, it closes at 3 p.m. CST. So at every night, so before the next day, essentially, usually around 8 to 10 p.m. CST my time, I pick a stock, whichever one looks the best structure-wise, and I can get the best chart set up from. That's the charts. Those are the trades and the markets that we're going to look to take trades in the next day or get into overnight positions for the next day. All right. Now, what you're going to be wanting to do, regardless if you trade stocks or not, is you're always want to go start with the daily time frame. Now, you might be like, oh, this is the basic thing, start with the daily time frame to see the overall trend and this, that, and the third. No, not at all. You're going to go to the daily time frame simply to mark out current and relative daily highs and lows. Now, because one, yes, you could do that on lower time frames, but mainly because you want to make sure that you get them absolutely perfect and on the money. Therefore, you don't have to get caught. Therefore, you don't get caught in a reversal if prices already swept liquidity and you just didn't know. And yeah, that's really the ultimate reason why. But what you're going to, all right. So what you're going to do is you are going to mark out the highs and the lows, like I just said, of each candle, because each candle on the daily time frame is a whole day, meaning the high point and the low point is the high point and the low point of that day. Now, we're not just going to be marking out the current days or the previous days, daily highs and lows. We're going to mark out relative daily highs and lows. If you've seen my primary liquidity video, which is a W video and y'all blew up, but essentially we're not just going to be looking at the current days or the previous days daily highs and lows, because those are obviously easily going to get seeked out. We want to have the relative daily highs and lows that are within the area, meaning if price does break through that first one or is still pushing strong in that direction, we have more confluences to hold into that trade or get into another position and hold it to an even longer extent. You feel what I'm saying? And you can't do that, and you won't be able to notice that and have that confidence with those confluences unless you mark it out. Therefore, we're going to mark out the current days or the previous days market open highs and lows. Today's Saturday, so this is Friday, but we're also going to mark out relative areas that price could actually sweep out within a certain time frame. And we'll even mark out down here. Those are areas that I could see price actually taking out. You feel what I'm saying? I don't see price getting all the way up here unless the pre-market is just super high up. You see what I'm saying? All right. Once you got that done, now you're going to want to drop to the 4-hour time frame. Oh, this is where we're going to be looking at the overall direction. No, this is where we're just going to be marking out the 4-hour highs and lows. Okay. And I'll explain why I'm saying no in terms of looking at the overall direction, this, that, and the third, because some people might be like, oh, you're freaking crazy, this, that, and the third. You don't know what you're talking about. I'll explain in just a second. All right. But here, we're going to be marking out the 4-hour highs and lows. Obviously, within the stock market, it's only open for like 7.5, 8 hours. Therefore, there's not, actually, I believe it's, 7.5, not 8 hours. Therefore, it's only going to be like one 4-hour candle, maybe two. 2 from the market open to about 12:30 my time. So the first 4 hours. And then, you'll mark out whatever you can get there, essentially. All right. And then we're going to drop to the 2-hour and the 1-hour time frame. This is where we are going to be looking at the market's overall structure, overall direction, comparing current history to previous history. That's going to give us our overall understanding in terms of where we can expect price to go the next day. All right. Now, you might be like, okay, and I'll explain right now, is why don't we use the daily time frame and the 4 hour time frame? That's what we were supposed to use. So let me get my face more mic in the microphone. That's what we're supposed to use for the overall direction and understanding, wanting to trade with the trend and this, that, and the third. And yes, you should want to trade with the trend ultimately. But what I've noticed is that daily time frame, 4 hour time frame and above, those higher time frames are good for long-term positions because they are more condensed. They give you an overall look within a monthly time span, within weeks, etc., etc. Those are good for long-term positions because it gives you a condensed structure of what you can expect it to continue with. But if you're looking to get in and out of trades that day, or look to hold something overnight and get out the next day, or hold something max within a week, 1 hour and 2 hour. I've spoken about it many times towards students. I put it out on my Instagram. I think I mentioned it within the YouTube video, but you want to use the 1 hour and the 2 hour because it is not so condensed like the 4 hour and above to where you're only able to see certain highs and certain lows for long term. But it's also not too stretched out to where you can't see any highs and any lows. It's condensed absolutely perfectly to where you can see every single high and low that's going to be put into the factor of the overall structure in terms of where you can expect price to go to. So now now that that's explained, 1 hour to 2 hour, what we're going to be doing here after we marked out the liquidity perfectly. Well, not perfectly. I'll reset it on the 5 minute, but essentially now we're going to be looking at the structure, overall direction, and comparing it to previous history. Previous history has obviously been bullish, forming higher highs and higher lows until we got here and started forming lower highs, still forming these higher lows though when we started picking up, but still forming these lower highs, giving us this kind of like triangular thing. And then guess what? We broke out to the sell side, breaking those higher lows, pulling back, forming a lower high. And then guess what? With all that sell side pressure, we can expect price to form another lower low. I think I meant to say lower low and lower high to those two things down here. All right. Now, we're going to be marking out our POI zones, as I mentioned, on the 5 minute time frame to get them more exact. And what POI zones we're going to be marking out. If you're trading in the stock market, then obviously you're going to be using these. And if you're not trading in the stock market, only 2 of these 3 you'll actually use as confluences, not things to actually trade off of, at least one of the 3. But it's going to be market open and close gaps, supply and demand, and imbalances or fair value gaps. I'm not an ICT trader, but in terms of the name of the terminology, I do use that, but I'm not an ICT trader. But I do agree at least with the imbalance terminology ultimately, just in terms of that equilibrium needing to be, equal within the market, et cetera, et cetera. That's the only thing that I use, but I don't use it because of being an ICT trader. That's just something that I ended up learning. And then eventually I found out that's actually an ICT concept or whatever. So do not throw me in the lines of an ICT trader. I am not an ICT trader. All right. For sure. But yeah, so in here, matter of fact, before we start marking out POI zones, we're going to make sure that all of our daily highs and lows were actually marked out correctly. Boom, just like that. Those, it's like basically equal highs at that point. You feel what I'm saying? But we'll still just keep it like that. Boom, we got that 4 hour low. Well, I'll make this red because we will have to mark a gap out there eventually, which I'll go into detail in terms of how to do that. Just give me a second. All right. Don't worry about me placing the gap right now. I'll explain that in just a second. So we're just gonna make sure our daily highs and lows are on the money, meaning if price takes it out, it's not like we've already taken out 5 minutes ago, and we are able to get in and out of our positions as soon as possible without any worry or confusion. And then we're gonna go all the way over here, make sure that looks straight. All right, boom. All of our primary liquidity points, daily highs, 4 hour highs, old 4 hour highs, lows, old daily highs and lows are all marked out and set up perfectly. We are now going to mark out the standard liquidity. Now, for those who have not seen my standard and primary liquidity videos, essentially, it's my terminology for an overall understanding that essentially the market wants primary liquidity. It wants big liquidity points. Yes, it'll use the small liquidity points, standard liquidity. So the basic standard, lower highs and the higher lows. It will use that to reverse off of and to even continue off of, ultimately to seek out big liquidity points, which are the daily highs, lows, 4-hour highs, lows, and the older ones, because those are going to have the most money. Market wants money. Money fuels the market. That's why we see these big drastic moves, and that's what ultimately adds into its overall structure. And without that, we have nothing, okay? Meaning price is going to seek the big liquidity points, whether that's by just manipulating to those big liquidity points or utilizing the small liquidity points, again, standard liquidity, the lower highs and the higher lows, utilizing those to seek out the bigger liquidity points. If you need to slow that down, slow it down, repeat it, whatever, because I know I said that a little bit too fast. Ultimately, I have a video talking about primary liquidity, all right? Now that we have, actually, no, we still got to mark out our primary liquidity points. We got our highs over here, and you might be wondering why I'm changing all the colors. I'm changing all the colors because I don't want to be assuming that, oh, this is a big liquidity point when it's actually just something small, minor, like a standard liquidity point. Or I don't want to think it's a standard liquidity point, but it's actually a big liquidity point, meaning these all have certain significance. Purple lines and black lines. In this case, I got a red line because it's going to be covered up by the gap above. Those are what I use for the daily highs and lows, 4-hour highs and lows, because those are the big liquidity points. I want to make sure that I know exactly what market is seeking out at the moment. All right. And now we have all of our primary liquidity points marked out within a relative area. Okay. At this point, now we need to mark out our point of interest areas. The main ones that are going to be used when it comes to the stock market is going to be market open and close gaps. Now, if you don't already know, market close and market open depends on the candle. If we close with the bearish candle like we did over here, then that means we opened above and we closed down below. Because in order for a candle to come down bearish, go to the sell side, it has to open above and close below. And then with a bullish candle, it has to open below and close above. That's how it pushes up from down below, and that's how it pushes down from up above. All right, meaning, in this case, we have a bearish close from Thursday, meaning that we're going to mark that at the bottom of the candle because that's where the market closed, because we opened above, we closed here. And then we opened with the bullish candle, we opened here, we closed above. And on top of the confluence in terms of where price actually closed and opened, just look at the previous candle or the next candle. In this case, we closed here, price opened another candle above here, meaning price closed here, we opened here. And then in this case, okay, markets closed. Okay, this is the previous candle. We opened here, we closed there. Simple as that. All right. That's one POI zone. Above, I already knew there was a gap up here. This is me literally redoing the video because it lost the recording. But this is an example of a bearish on bearish candle. Okay, we're going to mark this at the bottom of the candle body because that's where the market closed, and then we're going to mark this at the top of that bearish body because it's a market close and open gap. The close was at the bottom border of the candle body from Wednesday, and then the open was at the top border of the candle body from Thursday. And on top of that, guess what? We closed here, we opened up here, we closed above, we opened up here, we closed below. Use that as your confluences in terms of if you forget the terminology of where a price closes and opens on that candle. But again, slow it down or take notes. I'll even put it right here on the screen. Bullish candles open at the bottom and close at the top. And bearish candles open at the top and close at the bottom. So depending on what you trade will determine if you'll actually use market open or close gaps. If not, you'll be using supply and demand and fair value gaps / imbalances. Supply and demand, as we see right here, is going to be based off of a big impulsive candle, just like that. And then we're going to mark out the previous candle from its high points. Okay, let's zoom that in real quick. Big impulsive candle. Mark out the previous candle. Just like we had over here. This was also a supply zone. We had a big impulsive candle. Boom, marked out the previous candle. Guess what? Price tapped into it, rejected off of it. You could immediately got into sell short positions or put option contracts when you start seeing some volatility to the sell side, which would have been probably around here-ish. And then boom, take it all the way down. All right. Now this one's already been used. Also, it's kind of within the same area, so I'm not going to put that there because it's just going to fill up my screen way too much. I want clear charts, all right, or as clear as they can be charts. But that's going to be supply and demand, big impulsive candle, mark out the previous candle. It's literally the easiest thing. Support or resistance, yeah, that's easy. You just got to mark out relative highs and lows that all rejected and reversed in a relative area. But supply and demand is so much easier than that. All you do is just look for a really big candle and mark out the previous candle. Like another example over here, boom, big impulsive candle to the buy side, marked out the previous candle. Guess what? Price tagged into it, rejected, rejected, color switch, rejected again, big bullishness, big bullishness. Congratulations. For imbalances, for those who do not know how to mark out imbalances, essentially, you're going to be looking for impulsive candles and you're going to be filling in the overall gap within the candle structure. Just like that. So as we can see here, we had one candle, big impulsive candle, another candle, and a big old gap within between it. Price should every single time do this. Wick, bullish candle, wick, candle, wick. There is no gap within it. That would be a balanced candle. But whenever price moves vigorously in a certain direction and leaves this opening that isn't filled by the wicks of the current in the previous candle, then that leaves that gap. You fill that in, you wait for price to react off of it. As you can see here, we were big bullish until we flipped it all the freaking way down. All right. Now, fair value gaps, they can be used multiple times per se, but if you see price constantly coming back and retesting it and rejecting it, pushing up and then constantly retesting and rejecting, I'm telling you right now, based on previous history, it is going to fail and break. That's also why I will say this right now. I do not trade off of fair value gaps. I use it as a confluence in terms of where I could look to get out of because price could react off of it, and a confluence of where I could possibly put a stop loss because, again, price could react to it and stop it, or an area that, okay, this is where I could possibly get stopped out in terms of this could possibly reverse on me or will continue in this direction, or an area where price could stop and continue in my favor. So like here, okay, boom, big bullish candle. Oh, it might reverse on me and stop me out. Guess what? We have a fair value gap. I'll use it as a confluence if it starts rejecting, and I'll stay in the trade. That's what I use it for. I don't use fair value gaps. Oh, once price after the fair value gap rejects, we're in that. No. Balance, we've already filled in everything. Everything's either been inversed or already filled in to whatever extent. Therefore, we have nothing to worry about. All right. Now, you might be thinking, oh, well, that's it. We're done. That wasn't too crazy. No, we have to check our blind spots. Let's zoom out to the left. Okay. We already marked out those liquidity points that haven't been swept because those are the only things in the relative area that haven't been swept. Okay. Guess what? We have another gap right down here. This is a bearish to a bullish candle. My candles are kind of weird. Bullish candles that are actually bearish will still show up as like blue, which is bullish for me, and vice versa. But as you can see here, the market opened here with the next candle, closed there, meaning this is actually a bearish candle, or at least opened above and closed below. So bearish essentially. And then obviously the close was bearish. Therefore, we're going to mark it at the bottom. And then we are just going to extend this motherfucker to the right. All right, as you can see here, price tapped directly in the border, boom, pushed all the way up. And guess what? Big bullish trend to the buy side. See what I'm saying? And then we're not going to worry about that gap because it's within the same relative area. It's going to reject within it anyway, so it's not that big of a deal. So putting this more on a full screen, this is what we're looking at. We got our liquidity marked out. From the higher time frames, the primary liquidity, we got our standard liquidity marked down. The lower time frames, we have our POI zones, our gaps, supply, demand. All of our imbalance has already been filled. Therefore, we have nothing to really worry about when it comes to that. Granted, yes, price could still slightly react to those areas, but I wouldn't be too worried about them. Plus, I don't really see price really going up there other than maybe taking out this liquidity point right there. You see what I'm saying? And then again, we have our market open close gaps. From there, we just need to wait. Obviously, this has already been filled, meaning if I see price stooping deeper within it, that means I'm expecting price to fill the bottom border and also take out this low because the bottom border has already been filled. Actually, no, it hasn't. So I can expect price to fill in this bottom border, take out this liquidity, and most likely fill in this bottom border as well. this is what you need to do. See how I came up with all that crap? And let's say price does go to the sell side. That all fits into retrospective and my understanding, because I understood the structure of current history and analysis of current history to previous history on the 1 hour to 2 hour time frame. And on top of that, I have the POI zones. I have my liquidic areas, big liquidic areas that add into my confluences and understanding of why price is moving so viciously in a certain direction, meaning I know what to do whenever I need to do it. And yeah, but that's how you chart up. That's how you prominently chart up your charts, analyze your charts, get everything set up perfectly for the next trade day. So then you know what you were looking at, you know the areas where you can expect to take trades off of and also get out of your trades. All right. And then have a beautiful trade day, have a beautiful trade week. You feel what I'm saying? And yeah, so hope this was useful. Any questions? You can DM me whether that's on my Instagram or the Discord or in the comments. I'm trying to help some people out. You feel what I'm saying? So go tap into the Instagram, Discord. It's free, including the signals. So therefore, no risk other than whatever you implement. And my first 2 mentorship sessions are free for an hour and a half. All right. And that's going to be long term for however long my mentorship stays open. And yeah, so God bless y'all. And I will see y'all next time.